Here's a question most investors never ask themselves until it's too late. How much of my portfolio growth was skill and how much was just timing? Because here's the uncomfortable truth. Between 2010 and 2021, markets were unusually forgiving. Take risk almost anywhere and you were rewarded. That made it very hard to tell the difference between a good strategy and a lucky one. And bear markets, they don't forgive. They expose exactly which portfolios were built on structure and which ones only worked because everything was going up. I am Khalid Shamim from Quadra Wealth. For the last 17 years, I have worked with high net worth investors across the GCC. And I can tell you this with certainty. The investors who preserve and grow wealth through bear markets aren't the ones with the highest risk tolerance. They are the ones who understand that bear markets require a completely different playbook. Today, I'll show you exactly what that framework looks like. And this is education, not investment advice. But if you have built serious wealth and want to keep it, the next 15 minutes will change how you think about risk. Most people define a bear market as stocks down 20%. Now that's technically correct. But for serious investors, the real definition is this. A bear market is the phase where emotional investing gets punished and structured investing gets rewarded. It's where leverage gets exposed, weak balance sheets fail, and people realize their risk tolerance was theoretical, not real. And here's the part most people don't like hearing. Bear markets are where real wealth is built. Not because you magically buy the bottom, but because you stop treating growth and protection as the same thing. Let me describe a pattern I have seen hundreds of times. When market starts falling, investors move through a predictable emotional cycle. Denial, this is temporary. Hope, it will recover soon. Fear, I should do something. Capitulation, just get me out. And here's what makes it worse. By the time most investors capitulate, they have already missed the chance to protect themselves properly. The damage isn't caused by the first 10-15% drop. It is caused by months of stress, second guessing, and reactive decisions. This isn't because people are irrational. It's because the human brain is wired for survival, not investing. There's a concept called loss aversion. We feel losses roughly twice as strong as gains. So when portfolios fall, your brain doesn't say stick to the plan. It says end the pain. That's why willpower alone doesn't work. You don't beat bear markets with courage. You beat them with structure. And in a moment, I'll explain one protection tool ultra high net worth families use, one most investors never even hear about. Here's the rule that separates professionals from the public. In bear markets, capital preservation matters more than return maximization because the maths is unforgiving. If you lose 50% of your capital, you need 100% gain just to break even. So bear markets are not the time for heroics. They are the time for limiting drawdowns, protecting optionality, and staying liquid financially and emotionally. High net worth investors don't ask, how much can I make? They ask, how much can I afford to lose without changing my life? That single shift changes every decision that follows. Now, let's talk about the framework. When professionals prepare for bear markets, portfolios are usually built around 4 pillars. Pillar 1 is define downside. Instead of hoping markets don't fall, professionals define risk in advance. This is where structured protection comes in, not as a product, but as a principle. For example, a properly structured solution might allow participation in most of the upside while protecting capital unless market falls by more than say 50%. Now this is called engineering, and this is the tool I mentioned earlier, one commonly used inside private banks, rarely discussed publicly because it's designed for preservation, not speculation. Pillar 2 is quality over excitement. Bear markets don't care about stories. They care about balance sheets, cash flow, debt levels, and resilience. Speculation thrives in bull markets. Quality survives bear markets and leads the recovery. Pillar 3 is liquidity as a weapon. This is where most people get it wrong. In bull markets, cash feels inefficient, but in bear markets, cash becomes something else. It becomes optionality. It gives you the ability to act calmly when quality assets are mispriced. And those windows don't stay open for long. And here's the pattern interrupt most people miss. In 2008, the investors who made the most money weren't the bravest. They were the ones who had liquidity when others were forced to sell. Which brings me to a real example. In 2020, I worked with a client who had roughly a 2 million portfolio. When markets fell around 30% in March, his portfolio drawdown was limited to single digits. Not because he was lucky, but because protection was already built in. More importantly, he had roughly 400,000 in liquidity. So while others were panicking, he was able to deploy capital into quality assets in the month of April. That asset is up over 189% today. Not because he was brave, because he was structured. Pillar 4 is rules, not reactions. Professionals don't wait for fear to decide. They pre-decide when to rebalance, when to add exposure, when to remove protection. Not because they can predict bottoms, but because they refuse to let emotion write the strategy. So, when do you buy? This is the question everyone asks. And here's the honest answer. You don't buy the bottom. You build positions in stages. There's a specific signal I watch that tells me institutions are beginning to position for recovery. And it's not headlines and it's not GDP numbers, but the exact mechanism depends on portfolio structure, not public signals. What matters more is the principle. Markets recover before life feels safe again. The news will still be negative. Confidence will still be low. Everyone will still be skeptical. That's normal. Your job isn't to be fearless. Your job is to be prepared. Here's the most painful mistake I see. People hold through the decline. They tell themselves they are long term. And then, near the worst point, they break. They sell not because it's logical, they sell because they are exhausted. And that moment right there is where decades of wealth building can evaporate in a single emotional decision. Now, the right bear market strategy isn't just financial, it's psychological engineering. It's building a portfolio that keeps you rational when markets try to break you. So, here's the real takeaway. Bear markets are not something you fear, they are a filter. They reveal whether your portfolio has defined downside, liquidity, quality, and rules. If those four are in place, bear markets become less destructive and often more profitable. If you want to see how your current portfolio would behave in a 30% drawdown and what specific adjustments could reduce that risk without sacrificing long-term growth, you can book a portfolio review using the link in the description. And if this was valuable, like the video and subscribe. Remember, bear markets don't destroy wealth, unstructured decisions do. I'll see you in the next video.